Good afternoon, boys and girls. It's the Liberty Call for Tuesday, February 1st, 2022. I hope everyone's having a nice Tuesday out there. It's starting to get a little gloomy. We are expecting about 6 to 10 inches of snow over the next 24 to 48 hours. So I got that in my future. So for those of y'all who want to send me some warm thoughts, please do, because it's going to be a little chilly here in the next couple. Well, it's cold already outside. I think it's probably 20 or 25 degrees, but the sun is just now starting to get a little overcast. So the snow cloud should be coming in, and by about 6 or 7 tonight, we should start to see the flakes falling from the sky. So other good news, February, it's my birthday month. 2 weeks from today is my 48th birthday. So, God, I am getting old. I still feel like a teenager. I have the mentality of a 12-year-old, according to my wife. I'm not going to disagree with that because she's probably right. Because I love fart jokes and dirty movies or not like sex movies or anything, but crass comedy and stuff like that. So, anyways. Not that you came here to listen to me ramble about, what's happening this month and the snow that I'll get to shovel in the next day or two. If it's your first time watching, be sure to subscribe. Please share with friends and family. I would greatly appreciate it. So let's see here. Like I said, not a whole lot going on. I did run into town earlier just because I had to get my mail from the office. Looks like I got something from my accountant. And but I normally would go around 1 or 2 o'clock in the afternoon so that I beat the traffic coming out of Denver, heading back home. But with the weather starting to turn, I figured I'd go this morning. Weather was nice, beautiful, no traffic. Anyways, all right, well, let's go ahead and take a look and see how the markets have performed today. I call it quiet day in the market if I don't see a lot of headline or a lot of craziness on my TV screen over here on Fox Business. I never have the sound on. I just keep it muted all day just because I really don't care what they have to say. I just want to know what other people are talking about. All right. Dow Jones was up 0.78 today, closed at 35,409. S&P 500 was up 0.6, closed at 4542. NASDAQ was up 0.75, closing at 14,346. Small caps are up almost 1%. The VIX was down another 11.56% today, taking us down to 2196. So we're getting close to that 20 level I'd like to see things at. Obviously, if the markets are going to go, turn in a negative direction, the VIX will probably stay at or above 30 during that time. But until it's, stays above 30 and holds there, I'm not really too worried. The inflation sucks that we're dealing with right now, but, hopefully you have, if you're not working with me, you have, your advisor has some alternatives out there that are hopefully going to abate some of the inflation we're seeing. All right, across Europe, lots of green. I don't see a red anywhere until we get down to the TA35. Where is that? Oh, that's in Israel. Let's see here. Across the Asian markets, they were mostly down. The only one I see that's up is the Hang Seng at up 1.07. But the Shanghai, the SCSE component, and the and the China A50 were down, and the DJ Shanghai was flat. So, looking across the globe overnight, Asia was down, Europe was up early this morning, and then we had a real positive day. So, all in all, not a terrible day in the market. If you wonder why I'm talking so slow, it's just because there's not a whole lot going on right now. But I do have a couple articles that I am going to, I always say a couple. My oldest son, Ryan, when he was 5, when I met his mother, he used to always correct me and say, a couple is 2, a few is 3 or more. So Ryan, if you're watching this, I still remember those comments. All right, first article here, dollar slides for second day after weak U.S. data, Fed cautious rate comments. It's written by Gertrude Chavez Dreyfus. All righty. The dollar fell for a second straight session on Tuesday after hitting a 19-month peak at the end of last week on weaker than expected U.S. economic data and after Federal Reserve officials pushed back against aggressive rate hikes this year, lifting risk appetite. As the dollar eased, risk-sensitive currencies such as the Australian dollar, euro, and British pound gained. After falling nearly 5% in January, world equities started February slightly firmer, and currency markets have also changed course. A chorus of Fed officials said on Monday they would raise interest rates in March, but spoke cautiously about what might follow and indicated a desire to keep options open, given an uncertain inflation outlook. Philadelphia Fed President Patrick Harker was equally cautious on Tuesday as he pushed back on a rate increase of 0.5 percentage point in March, saying he would have to be convinced it was needed. Bro, come on, Patrick. Interest rates have been at or near zero for well over a decade. We are dealing with the inflation from all those years of malinvestment due to low interest rates. And now you're saying you don't think 0.5 point is really a good idea? Whatever. So, all right. All right. Louis Navillaire, Chief Investment Officer at Navillaire and Associates, said latest remarks revived the belief that the Fed was still alive, referring to the latency of the Fed to ease monetary policy or push back the timeline on rising rates in response to falling markets. In addition, the Fed sought to put the brakes on faster rate hike forecasts. Central banks around the world would have to either raise their policy rates already or flagged their own tightening plans. Given that yield differentials have shifted further in favor of the U.S. in that period, the greenbacks' failure to make further headway is somewhat perplexing, wrote Jonas Gotterman, senior market analyst at Capital Economics. But the key factor is probably that the most recent shift in the Fed stance has been broadly matched by other advanced economic central banks. Central banks in Norway, New Zealand, and Britain have already tightened their policy rates and signaled further hikes coming. U.S. futures late on Tuesday have slightly pulled back on faster rate hikes, pricing about less than 5 hikes this year. Starting in March, a 50 basis point rate increase showed a roughly 16% probability, down from a high as 32% late last week. In afternoon trading, the dollar index fell 0.3% to 96.423 after hitting a 19-month high last week. So what my fear is, and I don't know about you guys out there in the interwebs, but it seems like they're already, the Federal Reserve is starting to, create a soft landing zone if they are going to, reverse course, whether or not it's 6 months or 12 months from now, when the economy starts to quiver, or the stock market, has a massive pullback. They're going, oh, well, we might not raise rates as much as we claim we're going to do right now. So, but again, for those who've studied our history, and I've talked about this quite a bit, looking back to the late 70s, early 80s, Paul Volcker, the Fed chairman back then, had to raise rates up into the high teens. So, if you think a raise in interest rates up to 2 or 3% is going to, amount to, a whole lot, I just don't think so. I could be completely wrong. If I'm wrong, I'll, eat my hat, and I got a hat. I'll eat my old Navy cover, and, I'll eat it with barbecue sauce and maybe a little mustard. So anyways, see my boy Barney back here? He's a good man. Anyways, all right, let's go ahead and jump to the next article. Oil dips on potential for faster supply, OPEC plus boost. This is written by Laura Sanicola from Reuters. Oil prices slipped Tuesday from 7-year highs, pressured by speculation that that producer group OPEC plus could decide to boost supply by more than flagged previously, as well as expectations of a rise in U.S. inventories. While the organization of OPEC Plus has been expecting to maintain its policy of gradual production increases at a monthly meeting on Wednesday, Goldman Sachs said there was a chance of a faster ramp up given the pace of the market's recent rally. However, OPEC Plus technical panel did not discuss a hike of more than expected 40,000 barrels per day from March at a meeting on Tuesday. Sources said the Saudis will likely avoid any major adjustments as they have proven adept in recent years at uh, treading a fine line in maneuvering, I misspelled that, global pricing in their preferred direction, said Jim Ritter, Ritterbush, president of Ritterbush and Associates, LLC in Galena, Illinois. Brent crude was down 36 cents or 0.4% at $88.99 a barrel. West Texas Intermediate crude slipped 45 cents or 0.5% to $87.70. The market was also pressured by expectations that this week's U.S. supply report will show an increase in crude stockpiles. Analysts expect stocks to have risen by 1.8 million barrels. So that is maybe some good news. I mean, I personally don't see that we're going to see a massive drop in oil prices. Like I've been saying for the last year, until we get our rigs up to full capacity and maybe we reduce some of the ridiculous regulations that have been installed in the last 12 months. But, I'm not hopeful. So I would expect higher fuel prices for the foreseeable future. Okay. All right. Omicron restrains U.S. manufacturing, supply bottlenecks slowly easing. Written by Lucia Mutikani from Reuters also. A measure of U.S. manufacturing activity fell to a 14-month low in January amid an outbreak of COVID-19 cases, supporting the view that economic growth lost steam at the start of the year. But the survey from the ISM on Tuesday marked the third straight month of signs of improvement in labor and supplier delivery performance. Unfinished work increased at its slowest pace in 15 months, and manufacturers remained upbeat on demand. Still, Timothy Fiore, chair of the ISM Manufacturing Business Survey Committee, noted shortages of critical intermediate materials, difficulties in transporting products, and lack of direct labor on factory floors due to COVID-19 Omicron variants. While off to a somewhat rocky start, 2022 will be a good year for U.S. manufacturing, said Oren Klatchkin, lead U.S. economist at Oxford Economics in New York. The ISM's index of national factory activity dropped to a reading of 57.6 last month, the lowest since November of 2020, from a 58.8 in December. A reading above 50 indicates expansion in manufacturing, which accounts for 11.9% of the U.S. economy. Economists polled by Reuters had forecast the index to drop to 57.5. All of the 6 biggest manufacturing industries, manufacturing, food, transportation equipment, computer and electronic products, chemical products, and petroleum and coal products, reported moderate to strong growth. The economy hit a soft patch in December, which appeared to have persisted in early 2020 as coronavirus infections driven by Omicron variant. Does Omicron sound like a transformer? I just have to stop there. It's like these names are, I realize they're Greek, but, it seems a little, why not just call it, Fauci flu 2.5 or whatever you want to call it. Surged across the country, the ensuing disruptions at businesses and schools have led economists to anticipate a sharp slowdown in job growth in January. Makers of chemical products reported massive interruptions to our production due to supplier COVID-19 problems, limiting their manufacturing of key raw materials like steel, cans, and chemicals. Similar sentiments were echoed by their counterparts in the fabricated metals products industry. Transportation equipment manufacturers complained that transportation labor and inflation issues continue to hamper our supply chain and ability to service our customers. Machinery manufacturers said they were constrained by transportation restrictions and a lack of supplier manpower. But makers of non-metallic mineral products are seeing light at the end of the tunnel, reporting that the supply chain crunch may be loosening a bit. Stocks on Wall Street were trading largely flat. The dollar slipped. Okay, all right. That's just more fluff at the bottom of that. So some positive news. I know I'm always talking about all the negative things that are going on in the world, but this seems to, it seems like the supply chains are kind of loosening up. Maybe if Gavin the retard out in California would ease some of the restrictions around what trucks can come in and out of his state, maybe he could help out at the ports such as the port of Long Beach. All righty. Next article. This is pretty short. Fed's Bullard says unemployment rates can go below 3% this year. This comes from Reuters. Is there a person's name on it? Nope. St. Louis Federal Reserve Bank President James Bullard said he sees the unemployment rate falling below 3% this year, a jobless rate the U.S. economy last seen, I'd say last saw, in the early 1950s. I think unemployment is going to go down below 3% this year, Bullard said on Tuesday in a Reuters interview. The unemployment rate could continue to drop this year from its current level of 3.9% as companies scrounge for workers and several factors, including early retirements, limit the size of the labor force, he said. I think the upcoming jobs report will probably not be very good because of Omicron. But don't be fooled, said Bullard. This is quite the strong economy here and a very strong labor market. So here is where I will disagree with Mr. Bullard. So here's a chart. This is from Trading Economics. It shows United States employed persons, and we can see that we're sitting at about just a hair under 156 million employed Americans. And you can see at the beginning of all this madness, we were at 158, 159, somewhere around there. So there's still 2 to 3 million people unemployed, but the unemployment rate is basically where it was, at this point up here. So how do we have 2 or 3 million displaced workers, but the employment rate is nearly the same? Let me wonder. Maybe it's because those people aren't looking for jobs anymore. So anyway, like I said, I am optimistic that Mr. Bullard sees this as a good thing. There's still a lot of warts on that pig. And I mean, it's just, not that great. All right. Last article, opinion, what 401k and IRA critics are missing by Brett Arends. This is from Market Watch. The individual retirement account and 401k plans are coming under attack. These tax advantage savings accounts, which date back to the Employee Retirement Income Security Act of 1974, that was a good year, let individuals save thousands a year towards their golden years with certain tax advantages. They are now the cornerstone of America's retirement system. Investors, for example, held $24 trillion in assets in such accounts at the last count. But not everybody's happy. There are now multiple criticisms that these accounts, as they are currently structured, are unfair, even a fraud and a giveaway for high earners. I bet I can let me see. Who is criticizing? Let's see who the criticism is. Except Lorenzo Brescher, Riccardo Sabatucci, and Andrea Tomini. I have no idea who they are. All right. The main argument is that these accounts have ended up being tax shelters for rich people rather than retirement assistance for the middle class. My colleague Bob Powell wrote about this recently. He covered many of the key issues. I don't want to rehash those here, but I want to raise one additional issue that needs airing, which I think critics of IRAs and 401k plans have also overlooked. The issue, income volatility. In short, this year's high earners, quote unquote, may not be next year's high earner. Actually, this is a very good chance they won't be. And that makes all the difference to retirement savings. If we exclude high earners each year from tax breaks on retirement savings, we will create a perverse situation. Someone who, with a steady stream of income of, say, $70,000 a year, will get help with saving, while someone who earns the same $700,000 over 10 years in a string of booms and busts won't. This would be an excellent way of making a bad middle-class retirement situation even worse. Some of those criticizing 401ks and IRAs have already retired, so there will be no loss to them, no matter what happens to these plans. And others criticizing these plans work in occupations that enjoy legal shelter from too much volatility. For example, some of those criticizing retirement tax breaks for high earners are lawyers, college professors, or college law professors. People in the academy are trash. Anyone who hides in the university system their entire lifetime, it's kind of like working for the government your whole life. Be a man and earn your own living. Lawyers are protected from undue labor competition by a legally enforced high barrier of entry. Yeah, you got to have a law degree to even sit and take the bar exam, which I find to be crap. Law schools and bar exams in most states, you aren't even allowed to sit for the bar exam unless you have attended and paid $200,000 to an accredited law school and spent 3 years in class. Why can't I just go and study and then just go sit and take it? I bet I could pass it on probably the second try. Tenured college professors, meanwhile, are almost impossible to fire, even though their situation these days may not be quite as cushy as Michael Caine in Educating Rita. Most middle class workers, even so called high earners, can only dream of this kind of stability. Most studies found increasing income volatility for American households in general since the 1970s, reports the Aspen Institute. The increase in volatility has been the highest for households at each end of the income distribution. Nearly half of all U.S. households saw an income change of around 25% from one year to the next. It found about 1/4 of households saw it change 50%. A study by Pew found that a sixth of households earning more than $85,000 saw an income drop of 25% or more in a single year. And that's just within short periods. When you look at full careers, many middle class careers look like Egypt in the book of Genesis, a string of fat years when money pours in, followed by a string of lean ones when it pours back out. There is no reason to believe this phenomenon is temporary or going to abate. Quite the reverse. Silicon Valley and the NASDAQ team with young tech companies whose entire reason for existence is to disrupt existing paid industries. That means disrupting jobs. In most cases, they aim to replace those well-paid office workers with technology and apps, along with fewer lower paid grunts. Sure, maybe that's a good thing for the economy overall, as it lowers costs, makes things more efficient, and produces economic growth, but it makes middle class careers yet more volatile. All this means that saving for retirement is going to be harder when you face rolling career crises throughout your career and having to go back to school in middle age. Then saving money for yourself 30 years hence is going to seem less of a priority, but it is increasingly important. We are living longer. Life expectancy at age 65 is about 4 years longer for men today than it was 40 years ago, and 2 years longer for women. Meanwhile, fewer middle-class workers have traditional pension plans that pay them an income till they die. And Social Security is under increasing pressure, political as well as financial. If high earners who have retired feel they have too much money in their own retirement accounts, let them assuage their guilty consciences by giving to the needy. Yeah, I don't see a whole lot of that from a lot of people. They can even mail Uncle Sam a check. And if they want to argue with that high earners, however defined, are getting too good a deal, let them make the case for higher tax rates. But 401k and IRA plans, among the few steady things middle-class workers can hang on in an increasingly turbulent economy. So, yeah, and lastly, I mean, if you're making over $80,000 a year, you're in like the top 20 or 15% of earners. And I mean, really realistically, those making over 100,000 are paying like 80 or 85% of all taxes. I mean, if you're making less than 75, that group is hardly paying anything into the tax system. So, I feel, or I certainly want everything to be as fair as possible. But for people who have, lived their entire lives or work in an industry where they pretty much have a guaranteed paycheck unless they shoot someone, I don't have a lot of sympathy for you when you're complaining that it's not fair that other people are getting a tax break, especially in the university system where it's all government funded for the most part. So you get paid by the government. It's like government workers, they're getting paid with my stolen money. So anyways, all right, I'm off my soapbox for now. So hope everyone has a fantastic evening, and I'll be back tomorrow. Hopefully we have power and I'll be able to do my daily video. If not, I'll, as soon as the power comes back on, because that does happen when we have big snowstorms, power goes out sometimes for a couple hours, sometimes it's for 10 minutes. But all right, well, everyone have a fantastic evening, and I'll see y'all tomorrow for the Liberty Call on Wednesday. Bye-bye.